Imagine you built something worth more than the entire economy of Canada. Not a country, not a government, a company. One company, built by one guy in a Harvard dorm room that somehow became worth more than the GDP of the world's 10th largest nation. Now imagine losing all of it. Not gradually, not over years of slow decline, but in a single afternoon. In one trading session, on one ordinary Wednesday in February 2022, Meta, the company formerly known as Facebook, triggered the biggest single-day stock market crash in corporate history. But before we get to the number, and there is a number, one that will make you pause, hit subscribe, because what comes next is the part most people never hear. $230 billion in market cap wiped out. Gone. To put that in perspective, that's more than the market value of Nike, Ford, and Twitter combined. It's more than the annual GDP of Portugal. It's more than Warren Buffett's entire net worth at the time, and he's been compounding wealth for 60 years. And the dark, almost absurd twist? Nothing actually blew up. No fraud was discovered, no CEO went to prison, no asteroid hit their data center. Meta just reported its earnings, and the market decided in about 4 hours that it had been wrong about this company. Catastrophically, historically wrong for a very long time. This is the story of how that happened, and what it tells us about the strange, fragile mathematics underneath every tech giant you think you understand. To understand what broke, you have to understand what the market had been believing for a decade. Facebook went public in 2012 to widespread skepticism. People questioned whether ads on a social network could ever be serious money. They were spectacularly wrong. What followed was one of the most consistent growth runs in corporate history. Consistent year-over-year revenue growth and explosive profit margins. Wall Street rewarded them lavishly. By 2021, Meta was worth close to $1 trillion. Facebook's digital advertising duopoly seemed mathematically invincible. More users, more attention, more money. Until it wasn't. The first crack came quietly. They usually do. In late 2021, Apple released the iOS 14.5 App Tracking Transparency Update, a simple pop-up on your iPhone asking whether apps could track your activity across other apps and websites. Most people clicked no. That one click, multiplied across hundreds of millions of iPhones, permanently damaged Facebook's targeted ad model. Here's the thing about Facebook's ad machine. It doesn't just show you ads, it shows you the right ads, the ones likely to make you buy something. And it knows which ads are right for you because it tracks everything. Not just what you do on Facebook, but what you do everywhere else. That cross-app tracking is worth an enormous amount of money because advertisers don't just want eyeballs. They want proof that the eyeball led to a purchase. They want the feedback loop closed. Apple's iOS privacy update killed Facebook's conversion tracking for hundreds of millions of users, all at once. Meta later admitted this would cost them $10 billion in revenue in 2022 alone. $10 billion from one software update from a competitor's phone. The market told itself it was manageable, that Meta would adapt. Then came February 2nd. After markets closed on Tuesday evening, Meta released a disastrous Q4 2021 earnings report. The numbers weren't catastrophic. Revenue was up, profits were decent. But two numbers buried in the report changed everything. First, daily active users had declined. Not slowed, declined. For the first time in the company's public history, Meta reported its first ever decline in daily active users, or DAUs. The number was small, about 1 million users out of nearly 2 billion, a rounding error by any normal measure. But the market wasn't paying normal prices. It was paying growth company prices, and growth had just blinked. And then Meta issued disastrous forward earnings guidance for Q1. Slow growth for a growth stock is not a smaller reward, it's a completely different animal. By the opening bell Wednesday morning, the stock was already down 15%, then 20, then 25. By close, Meta had fallen 26.4%. $230 billion gone in one afternoon. Here's where it gets philosophically uncomfortable. The company didn't change between Tuesday and Wednesday. Same buildings, same engineers, same 2 billion users. What changed was a story. Markets don't price companies on what they are. They price them on what investors believe they will become. A stock price isn't a receipt for past performance. It's a bet on future growth. Think of it simply. A company earning $1 of profit per year, flat, forever, you might pay $15. But a company earning $1 this year and growing 20% annually, you might pay $200. The entire difference is the growth assumption. When that assumption changes, not collapses, just slows, the price doesn't adjust a little. It reprices every future year simultaneously, all at once. That's the invisible mechanism behind every major tech crash. It's not about today's numbers, it's about the revision of a belief about every future number that will ever exist. $232 billion wasn't lost, it was corrected. The market admitted it had been wrong, not about the company, but about the story. And then there's the metaverse, which makes everything stranger. While user numbers were softening and Apple was draining ad revenue, Meta was executing Mark Zuckerberg's massive metaverse cash burn, renaming the entire company to chase a virtual reality future. Meta's Reality Labs division lost $10 billion in 2021 alone, more in 2022, in exchange for almost no real users and almost no real revenue. So the situation was this. The core business that funded everything was showing its first signs of aging, and the replacement business was burning cash at theatrical speed, producing nothing. Slowing present, expensive future. The market looked at that combination and decided it had been far too generous. By late 2022, Meta's stock had fallen from nearly $400 to below $90, a 75% collapse in under a year. Then Zuckerberg announced massive tech layoffs, firing 21,000 employees, and pivoted to what Wall Street called Meta's Year of Efficiency strategy, quietly deprioritized the metaverse spending. The stock tripled. By early 2024, Meta was setting new all-time highs. Same company, same product, different story, which is exactly the problem. If a company can lose $232 billion because a story changed, and then recover it all because a different story took hold, what was the stock price measuring exactly? The value of the business? Sometimes. The collective belief of millions of investors about an unknowable future? More often. An elaborate, high-stakes consensus about a narrative that could shift on any given Wednesday afternoon? Uncomfortably, yes. The buildings didn't burn. The engineers kept coding. 2 billion people kept scrolling. But the story changed. And in the time it takes to eat lunch, a number the size of a country's economy quietly ceased to exist. Here's the thought worth sitting with. If $232 billion can vanish in 4 hours based on a revised belief and return a year later when a new belief arrives, was the wealth ever fully real to begin with? And if it wasn't entirely real on the way up, what were we all looking at? The market hasn't answered that. It just moved to the next story.